All right. Well then, Eric, welcome to the group here. Eric is the founder and he's the managing partner of the Oregon Venture Fund. And Oregon, let me know if this is true. Are you the largest and most active venture capital firm in Oregon and Southern Washington? That's quite an impressive statement.
Yeah, that's correct. And one of the largest in the Northwest too. Yeah.
Okay, great. So welcome to the Alternative Investing Club, and I will simply turn the floor over to you. People, if you have questions, feel free to put them into the chat. We'd love to see lots of questions. I'll judiciously interrupt you, Eric, if you want me to, or I can hold all the questions to the end. So just let me know how you want to do that.
Yeah, I'd love to get questions along the way. I think that'll make it more interesting. So
do you want to put them in the chat, or do you want people just to open up and talk?
Whatever you suggest.
Okay. Well, let's start off by putting them in the chat, and we'll see how active it is.
Great. And you should be able to see my slides. And thank you. Thanks, Daniel. Yeah, thanks, Daniel and Ashish. Thanks for having me, and wonderful to see so many folks interested in alternative investing, a subject close to our heart, as well as the concept of the ownership economy. So I commend you all for what you're doing, and thanks for having me today. It's a great honor. And what I'd like to do is to give you a quick overview of the Oregon Venture Fund, who we are, what we do, why we do what we do, and how we're structured, our strategy, and then go into some of the lessons learned, which I think is really interesting, things that we're learning. And also, I'd love to hear from you, things that you might have gleaned from your experience, perhaps with angel investing or early stage investing. I'd love this to be conversational and educational and informative for all of us. So I will jump right in. And again, please enter your questions in the chat. I'd love to make this as interactive as possible. So to level set, the Oregon Venture Fund is a regionally focused venture capital fund that invests in startups in Oregon and Southern Washington. And the performance of our fund is, as we've been very fortunate to have backed some outstanding entrepreneurs over the years. So we're averaging a 22% net IRR over all of our funds and a 2.9x net total return. So for every dollar invested in the fund, we're returning $2.90. And that puts us sometimes in the top 10%, usually and almost always in the top quartile of all venture funds globally. And we can talk about what has contributed to the performance, and we have some theories as to why, and hopefully these slides and my comments will trigger questions. One of the unique features of the Oregon Venture Fund is we have over 300 investors that are all over the world, but we have a subset of investors who are venture partners, and these are individuals who are often leaders in their field. Almost everyone is an exited or current entrepreneur themselves. They might be the CEOs of some of the larger tech companies and growth companies in the Pacific Northwest, or some of the emerging companies, but they have something to contribute. And so we collaborate very closely with our venture partners. And Ashish Gupta, who helped introduce me to Daniel, is an example of one of our venture partners. And that's part of our secret sauce. We invest in all sectors and in all stages, but we want to be the first formal investor. So we tend to invest at the pre-seed or seed level. And as of this year, we've invested over $150 million in 73 startups. And those companies have grown to employ over 5,000 people and have a combined market value of $4.4 billion based on exits and most recent financing valuations. And we want to invest in the most ambitious entrepreneurs who are creating durable businesses that will be the employers of the future in our region. So I'll stop there if there's any questions yet. And if not, I'll keep going. So every venture fund, just like every business, should have a competitive edge. It should be a leader at something. And the areas where we lead, we have three sources of competitive advantage, we believe. One is our regional focus that helps us get access to top startups in a region that tends to be overlooked and underserved with venture capital. And it helps us with our diligence, investing local, and it helps us support companies because we can work with them in person and individually. We know our region better than anyone, and that's a source of advantage. The other is our venture partners, this group of highly accomplished investors and entrepreneurs who are investors in the fund, who help us scout, select, research, evaluate, support startups before we invest and after we invest. And it helps us make better decisions and add more value than a more conventional fund. And then third, I think we're the only venture fund that offers either free ice cream or beer for life for our investors when a fund generates a 10x return or better. You have to pick one or the other. And we have a couple funds that are getting very, very close. So we're looking forward to the day we can offer our investors the free beer or ice cream for life. It's in our fund agreement. And we do have some ice cream and beer companies vying for the opportunity to be the purveyor of that reward for our investors. And so we try to have fun, and we focus on things that are important, like ice cream and beer. So what do we look for in companies? You know, we're investing in 4 to 8 of the top startups and growth companies per year. Again, in any sector, we want to get a venture type return. We're really looking for talented teams, most of all, and the path to get a venture return. Ideally, the company can get to profitability and liquidity within a 5 to 8 year period. And we have our geographic focus. And in terms of our strategy, again, we're really looking for exceptional teams. And we can talk more about what we look for in a team. And we surround each company that we back with as much love and support as they can tolerate from us. And we usually have 1 or 2 board seats, and we often help with recruiting. We help with customer introductions. We help with additional financings and M&A when that's time. So we do provide a lot of support to companies, and we feel that reduces the risk and helps accelerate returns. And we'll invest as little as $500,000 in a round, up to $5 million in a round, and we can allocate up to $10 million in a company over its life, assuming it's meeting all of its milestones. So we're one of the deeper pocketed venture funds in the Pacific Northwest, and that helps us be an attractive partner for the top founders. And in the last couple of years, a couple of companies in our portfolio that maybe we hope they'll be on everyone's radar because they're just growing super fast. One is Trova Trip, which is a social travel platform that allows influencers to organize trips all over the world with their followers. And it could be a chef, a yoga instructor, or someone who's into ornithology and bird watching. And it makes it really easy to plan trips with people who are interested in whatever your expertise is. And it's just growing phenomenally. Eclipsium is an Intel spin out that's doing cybersecurity for firmware in devices like laptops, cell phones, and they're taking off as well. So those are some of the companies that are growing in revenue and in growing in value. A company to keep an eye on is Customer.io. Pretty soon they'll reach 100 million in ARR. It's a behavioral marketing and consumer engagement platform that internet companies use to make sure that their users are engaging with the platform in a way that's meaningful for them. And it's just struck a chord, and they have 300 employees in over 30 different countries around the world. So that's an example of one of the companies we backed that's just taken off in terms of value. Brandlive is another. Brandlive is it's like Zoom, but more TV quality, and companies use it like Google and Apple and even Microsoft use it for internal company meetings and all hands, town hall type meetings, sales kickoff events. And it's imagine Zoom, but higher end and a better experience, more interactive, and it can be branded by whichever enterprise is using it. So that's another one to keep an eye on. And we've had a wonderful set of exits over the years to companies like Amazon and Autodesk and to private equity funds. We had a company go public a couple of years ago, Absci. And, so what we've been able to show is that there's wonderful companies that can grow and exit in our region. And that's given us confidence to grow what we're doing. And again, we've been fortunate to generate wonderful annualized net returns to our investors. And after about 6 or 7 years of investing, we found that investing in the Oregon Venture Fund has become self-sustaining, that individuals can reinvest proceeds and pocket some cash as well, maybe to cover taxes, but it becomes self-supporting after about 6 or 7 years. Maybe I'll pause quickly to see if there's any questions.
There are a couple of questions. Hello, I'm getting feedback. Okay. There's a couple of questions, and of course, it's always good to hear the intro just to know what the initial talk is going to be and the initial facts around the group. But then comes the barrage of questions, and so I'm expecting that. First of all, do you work with all sectors? And what is kind of the breakdown of the sectors that you tend to work with?
Yeah, we do invest in all different sectors. It just needs to be a venture profile company, and we can go into what we look for there. But it's about 60% are software and data centric startups. And as you can imagine, many are incorporating AI and ML in their business models. And we also invest in life science, material science, and consumer companies. There's a couple that folks might be familiar with. One is Salt and Straw, the ice cream company. We were one of 3 institutional investors that helped them go national. And they should be doing over $100 million in revenue by the end of this year. And another company called Rumple is a consumer product. It's fancy high-end blankets. And Rumple is to blankets what Hydro Flask might be to thermoses, or Yeti is to cooler. So it's like really well engineered and designed blankets. And that's also taken off. So that company's called Rumple. So we're not afraid of consumer products, but we love companies that are solving really hard problems and or making the world a better place. And if they're successful, we want everyone to feel good about those companies.
My family actually mentioned yesterday at dinner that they went to Salt and Straw in Wichita, Kansas, I believe.
Oh, really?
So
okay.
It's known, and it's out of the Pacific Northwest, nationwide.
Yeah.
So, okay. Do you specialize in seed funding or Series A, B, C? Is there a particular point at which you like to come into the capital?
We love to come in early. So pre-seed and seed is our preferred entry. We might put $500K into a company to help them get to market, and then follow up with $1 or $2 million the next round to help them scale. And so we want to be an early investor, but we also, if a company is performing well, we'll continue to invest in each round along the way. But we feel we can make the biggest difference and get the greatest appreciation if we invest early.
Okay. There's a quick question about your VC hit rate. And I assume that means, maybe perhaps that's an industry term, but I'm assuming it's referring to how many businesses succeed as opposed to fail.
Yeah, and we're very data driven, and we want to embrace evidence-based investing. So we track, everything about our work, our deal flow, our investments, and performance. And it's almost boils down to a Pareto principle where roughly 20% of our investments have generated 80% of the returns to date, and but roughly half of the companies we back fail to generate a positive return. And that's expected and probably indicative of the risks that we're taking, that we're investing early, we're swinging, the entrepreneurs we're backing are swinging for the fences. And so we're going to strike out. But the ones that do well tend to more than make up for the ones that don't.
I suppose that leads the question, are there any particular indicators that you really look for, or a checklist of things? What is your checklist of things that you think will help a beginning company scale to that next level?
Yeah, in terms of what we're looking for, we're looking primarily for exceptional teams, the kinds of individuals that you and I would want to work for and work with, because they're visionary, they're bringing some, insights and expertise, and they're great managers, great leaders. And so we're really looking for great teams. We want to invest in companies that everyone can feel good about if they're successful. So we tend to avoid some sectors like gaming, gambling, alcohol, recreational drugs. And we like companies that are solving a really hard problem. The ideal company, I would say, is it's like an insanely great team solving, with a must-have solution that's targeting a large potential opportunity. Most of the markets don't exist yet, or they're emerging markets, but potentially it needs to be a large market. And I actually have a whole bunch of slides on kind of what we look for in diligence that I'll get to in a second, but maybe it's okay. I'll go through a few more slides to kind of ground us in our fund, okay. And then we'll go into some of those lessons learned and what we look for.
Let's do a few more slides and go through that section, and then we definitely have good questions about the funds that are.
Oh, great, good, okay, super. So just a sense is we're super collaborative. We're often the feet on the street for other venture funds and private equity funds. And so we tend to partner closely with the other venture funds who are sector specific or stage specific or business model focused. And so these are some of the venture funds and private equity firms that we partner with. And that really helps, we think, add more value to the startups. And then we have a growing number of corporate investors who we collaborate with based on what sector that startup is in. And we've probably done half a dozen deals with Intel Capital, for example, and they've been wonderful partners over the years. And then we've got a full team. There's 9 of us working full-time at the Oregon Venture Fund, and many of us are exited entrepreneurs ourselves, and we've scaled businesses. We love investing. We love innovation. We want to be helpful to startups. So that's a big motivator. And then I can go into some of our learnings, but maybe we can pause quickly again, Daniel, if there's a question.
Sure. There's actually a couple of questions related to the fund itself. In particular, what are your liquidity requirements, or when can you move money in and out of the fund? What are the requirements there?
Yeah, that's a great question. So we create a new fund every calendar year. So individuals can invest anytime. Like right now, we're finishing up our fundraising for the 23 calendar year. And then in the fall, we'll organize and raise the 2024 fund. So every calendar year, we do a new fund. And what that does is it allows people to invest whenever they're ready. And it helps us accommodate investors year round. And it also provides a choice for investors. Most venture funds, as you all know, you make a commitment over 3 to 5 years, and you're obligated to contribute capital during that period, even if you have a health emergency or you want to use the capital for something else. and the penalties for not investing in a capital call can be severe. We did not want to subject our investors to that kind of dynamic. And when we got started, the SaaS business model was taking off. So we thought, well, let's take a page from the SaaS model and see if we can do venture as a service, which for us means that our investors have the choice each year of investing. And we have to earn the repeat business of our investors by performing well and communicating well. And if we do that well, then our investors renew. And we have about a 90 to 95% renewal rate among our investors each year. So our churn is pretty low. But that's one of the innovations we came up with. And it just allows our investors the option, but not the obligation to invest each year. And in terms of liquidity, the average time to the bulk of liquidity is about 6 to 8 years. So the investments that we make this year, statistically for us, pay off in 6 to 8 years. And each annual fund has a 10-year life. So the goal is by year 10, all the investments we've made will have harvested and exited and all the proceeds distributed. There's no liquidity for us or our investors while we're in the portfolio. So that means that we all get paid with gains when companies exit and not before. And when companies exit, we distribute the proceeds immediately. And then investors have the choice of either reinvesting or pocketing those proceeds. Hopefully that makes sense.
I think that does. And there are people here who, obviously have never invested in venture funds before. And so we have one, I think, on the fundamentals of why are investments done in rounds? What constitutes a round? Why is it done that way? Why not just as needed or on a periodic basis? What's a round?
Yeah, part of it's driven by state and federal regulations that require reporting of investments. So you need to, every time we do an investment, it gets all the investors get included in a schedule that's reported to the SEC and also to the state in which the company is incorporated. But it's really because a round is based on the valuation of the company at that time, right? And valuations change based on the company's progress, whether they're meeting milestones and succeeding with their mission. And so each round will have a different valuation. And it's really hard to accommodate investors in between rounds because it's really hard to know what that valuation is. So when we invest in a round, we'll typically lead the round, which means that we'll propose the valuation and negotiate what it is with the founders. And then other investors will follow and participate on the same terms and the same valuation. And successive rounds might have a different, hopefully a higher valuation, and it might have different terms too. It might have different board members, might have different liquidation preferences or different rights for investors. So each round, is kind of a set of rights and preferences and valuation that's specific to that round. And so it's easier to do that. And, a round can be open for 3 months or 6 months, but usually not longer because the valuation will either go up or down after that point.
All right. Let's hold the questions for a little bit and jump into the learnings. I think you might touch on some of the answers.
Okay. Yeah. So I just thought I'd share some of the things we're learning. We want to be a learning organization. Like all of you, we love the investing process. We want to learn from our successes. We want to learn from our failures. And we're always trying to get smarter. And we're humble enough to know that we don't have all the answers. But I thought it'd be fun to share, some of the things that we're learning. And one is, that it's really from our friend Warren Buffett. Be greedy when others are fearful. And, our approach to investing is similar to dollar cost averaging in the sense that we're investing in bull markets and bear markets. We're investing in growth periods of growth and during recessions. And that's because our annual fund structure allows us to have capital all the time. And like right now, we're in this period where venture capital has kind of dried up. The rate of venture capital investing right now is 1/3 of what it was last fall, right? So a lot of venture funds have just frozen. And that creates opportunities for funds like us who want to be active. And so valuations have come down. We can make terms instead of take terms. And then the deals are less competitive. So, just like dollar cost averaging over time enables an investor to take advantage of price changes, we're doing the same. We have this, we're always looking for biases, and I thought I'd just list some of the biases that we're trying to be cognizant of when we're selecting investments. And, one is an anchoring bias. Most venture funds will ask entrepreneurs, what valuation would you like for your business? And we work really closely with companies before we invest, but we let our diligence inform what that valuation should be. And so we'll do our diligence and we'll say, hey, we think you're worth 10 million. We'll add, $1 million in value for every engineer on your team, and we'll subtract $500K for every MBA on your team. No, I'm just kidding. But we'll figure out what we think is an appropriate valuation and not anchor on what they're saying. Investors tend to anchor on prior successes. They look for companies that pattern match what they've done before. We try to be open-minded. There's a similarity bias that we try to counter. Venture industry is famous or infamous for investing in entrepreneurs that look like them, talk like them, went to same schools. And we really want to democratize entrepreneurship and invest in people with all different backgrounds. And they may not be as well connected or as well educated. They might speak with an accent. And we love that. We want to support people with all different backgrounds and try to avoid that similarity bias that has led to, in part to the bro culture that Silicon Valley is infamous for. And there's other bias.
That has been one of our core values here in this club as well. And we really appreciate that, I believe.
That's great. That's great to hear. One of my favorite is this IKEA effect that, venture funds tend to follow a founding team for 3 months, 12 months. They do a lot of diligence. And it's very easy to fall in love with a startup just because you spend a lot of time researching them, getting to know the founders. And we call that the IKEA effect, just like people fall in love with the furniture. They value the furniture they've put together themselves. Just because we spend a lot of time with the founding team, we want to make sure that we're falling in love for the right reasons and not just because we've become comfortable and familiar or we feel like we've put a lot of effort into the deal, so we have to consummate it. And then loss aversion is another. And we have a long list, but this is kind of to give you a sense of the kinds of biases that can creep into venture investing that we want to be cognizant of and we kind of look out for. Now, this is kind of our core IP. This is something that we came up with that we feel cuts across all sectors. So what we were looking at, just like in physics, scientists have been looking for, universal theories that cut across, everything that can be applicable in all places, right? And Einstein looked for, grand universal theories. We feel like we've come up with an approach to early stage investing that is kind of applicable regardless of business model, sector, or stage. And that is that the probability of product market fit, of getting, which is elusive and highly valuable, is a function of learning. And it's really the quality of learning, the velocity of learning, and the cost of learning. And we want to invest in companies where this ratio is as positive as possible, where companies are set up to learn valuable insights quickly and do that efficiently, cost effectively. So for example, we've invested in a few pharmaceutical companies over the years, and think about the the cost of learning. We'll maybe fund a rodent study on the toxicity of a drug, and that study might take 6 months, and we get an answer, and it could be positive or negative. If it's positive, then the investors might fund a primate study or a large animal study. And if that's positive a year later, then you can do maybe a pilot or a first phase human clinical trial. But the pace of learning is slow. The quality of learning is good, but it's intermittent. And the cost of learning is very high. And that's like pharmaceuticals. And then you got to like software, and you can update, you can do an A/B test, right, with software. And during the lunch hour, you can figure out how to update the software. And by the afternoon, you've got an updated platform that's incorporated what you learned that morning. And then you get to AI, which is like the ultimate learning machine. And the learning is incorporated instantly and free. And that's why we love, well, one of the reasons we love AI and ML so much is that the quality of learning can be high, the velocity can be fast, and the cost can be low. So that's one of the reasons that venture funds in general gravitate to software. And it's just much more attractive. And the premise here is that startups are learning organizations. An existing company is focused on how to operate efficiently and effectively. They're learning about, how to improve products, but startups are really learning organizations in search of a viable business or revenue model. And the more we can, gravitate to startups that can learn quickly, cost effectively, and learn valuable insights, the better. So this is something that we look for. And that informs some of the attributes that we look for in a founding team, right? We want to invest in founders with a learning mindset. And I'll introduce these. We can go into more detail if folks are interested. But when we look at a startup, we're looking at 4 different, what we call abilities. And these are categories. And we have about 10 to 15 predictive indicators in each of these buckets that we'll look at to help inform whether we should invest or not in that startup. And so leadership ability, as you can imagine, is about the characteristics, the background skills of the founding team. Defensibility is about, what provides a durable, sustainable, repeatable, competitive advantage, like a moat, or it could be branding related. And then scalability, of course, is about network effects, growing efficiently, getting operating leverage. Labor-intensive businesses, of course, are less scalable than software-intensive businesses. And then exitability is a series of factors around the nature of the acquirers of the business, as well as the kind of business itself. But before I get into these, it might be interesting to look at some of the questions that the folks have asked. How's that, Daniel?
Yeah, there are a couple of questions that relate directly to this. And one of them here is from Vindra. How often do you revisit the startup milestones, and what is the criteria to pass the current phase to get funding?
Yeah, if I understand the question right, when we make an investment, we'll work with the founders to set milestones for the round. And it might be to get to revenue, or get 100K in revenue, or $1 million in revenue, or get 10 paying customers. And it could also include, filling out the team and hiring some key hires. But there's a set of measurable milestones for that round. And ideally, if those milestones are met, the next round will be at a higher valuation, right? And so we track progress towards those milestones. We try to help and accelerate progress towards those milestones by supporting the company. And if all goes well, then we or someone else can lead another round at the higher value. At the earliest stages, it's interesting, the milestones aren't just KPI type milestones. They're also about, the quality of learning and pivoting. And a company might fall short of their stated milestones, but they might learn something that's even more valuable than they thought they knew, and pivot and restart. And that's great. As long as the company is is learning and coming up with something that's going to be more likely to lead to product market fit, we'll consider that a success and reinvest. So it can be a little qualitative.
That's actually really interesting. At Intel, of course, we use the OKRs and KPI models. And I was going to ask about if you use that same method, but it sounds like you have a hybrid approach where you take learning into account as well. And I think on a functional level, a lot of teams at Intel do that. Correct me if I'm wrong, maybe some don't. But that's an interesting way to talk about it, because it is acknowledging that the learning there is a pivotal part of the entire process. We have a question here about how are the investors rewarded based on their startup performance?
Yeah, well, it's, we're all in this for long-term capital gains, right? And so the goal is to grow the value of the equity as much as we can, as quickly as we can. And so the reward is the eventual exit, right? When if a company goes public or sells, and we can distribute the gains. And we're shooting for, at least a 10x, ideally 100x or more potentially in terms of the gain, and then to distribute that. So that's really the reward, but it's interesting. We also know that, folks want to know, who they're backing, what they're investing in. And so we tend to over communicate the stories behind the entrepreneurs. And that's also a reward, is that we're a small part of their story, right? They're doing the hard work, and we're providing critical capital and support. And we want to follow along, and we want our investors to know the good, bad, and ugly. And we realize that our investors don't just want a superior return. It's almost like they're buying a ticket for a roller coaster ride that's going to have highs and lows and thrills along the way. And that's part of the fun, I think, of what we're doing. And we know, despite everyone's best efforts, some of these companies aren't going to succeed. But when they do, it feels great. And we know the struggles that the founders are going through, and we feel for them. We have empathy, and we're supporting them. And we want the founders that we're backing to be perceived as, as heroes, like sports stars. And our founders are to us as Nike athletes are to Nike. We elevate them. We want their stories to be popularized. And that feels good to know that we're helping these people achieve their dreams and make a dent in their market. So that's another kind of psychic reward that we can offer.
How this is something I'm curious about. How formalized is the training that a company that you take on receives? Is it all completely, are there standardized, training units that you can bring to a company that will help them scale their efforts? Or is it really on a personalized, everything is customized for the particular business, and it's hard to reuse those training modules? How do you structure that?
Yeah, that's a great question. I love that. It's interesting that there is increasingly a playbook for going to market and ways of learning quickly, like we talked about, how to learn from your customers, not just their stated needs, but their revealed needs, and understanding not just what customers say they want, but what they really need in terms of a solution. And so there is an increasing playbook to accelerate that learning and getting products to market quickly. And the lean startup methodology is one example that it cuts across a lot of sectors. But the interesting thing is, with entrepreneurship, almost by definition, these startups are doing something unique that hasn't been done before. It's often at the intersection of disciplines and industries, and they're creating variations of business models. And, so some of it really has to be developed idiosyncratically or uniquely. What we try to do is we'll have workshops for all the portfolio companies we're involved with that might talk about how to manage your board, how to get the most out of your board, or how to create a sales team and a sales motion and how to get that started, or best practices and compensation. But the companies are so different. A lot of it is one-on-one. We try to find operators or entrepreneurs with deep experience in a related market to coach each company and to try to open doors and share insights whenever possible. But a lot of it is try, test, fail, iterate, learn, and do again, right? It's that, and if we can accelerate that try and test experience for startups, that's probably the most effective.
I'm curious about your relationship with other venture capitalist firms in the area. Do you work with them or communicate, hold joint events? How do you react and relate to other venture capitalist groups?
Yeah, we try to be as collaborative as we can. And, we're based in Portland, which I think helps, where it's just a less competitive venture environment. If we were doing what we're doing in Seattle or the Bay Area, we would probably have to be much more proprietary about our deal flow and our strategies. But because we're in this kind of underserved and overlooked market, we need to collaborate with other venture funds. And so we do talk to firms in Seattle quite a bit: Flying Fish, Fuse, Maveron, Madrona, Voyager are some in Seattle that we work very closely with and often co-invest with. And the same in the Bay Area. We have a couple dozen firms that we collaborate with, and we try to get their advice before we invest, and we try to include them in our rounds or after us. And then once a year, we bring together all the venture funded companies in our region and their VCs to talk about what we're learning and to help us improve our game. So it's kind of a self-help group, professional and personal development retreat. And we organize and host that every year in the wine country in Oregon. And we get maybe 30 or 40 VCs and maybe 60 to 70 venture-backed startups all coming together. And we feel like that also helps set the tone that, we can, there's a lot we can learn from each other. And there is. And so we want those connections to occur.
That's great. I actually have a colleague named Tim Abels who was an Intel architect, and he is starting his own venture capital firm. And this will be the first event that I'm attending in Oregon for venture capital. And I'll just indulge me, I'll put the link there. And I have no affiliation with them whatsoever, other than just I know the guy and their team. But how do people get involved in events that you're doing? Is it do you just go to your webpage and sign up, or how do you involve the community?
Yeah, we try quite a bit to be visible and accessible, and we also try to support organizations, universities and incubators and nonprofits that work with entrepreneurs. And we do, one of the things we do is we have slow pitches where we might work with Pitch Black, which supports Black entrepreneurs, or TIE, which supports all entrepreneurs, but a lot of folks with heritage from South Asia. And we will and do a pitch event where anyone can come and pitch their idea. We bring our investors. We try to be helpful, and it's a wonderful way to help companies, even if we don't invest. If folks come to our website, Oregon Venture Fund, you can sign up for our newsletter, which we send out each month. And in the newsletter, we also try to showcase upcoming events and ways that people can collaborate and participate with us.
Do you know offhand when your next event is, or should we go to the website?
Yeah, there is one.
Fine.
Not offhand. Yeah.
Okay. Karthik is asking, do you raise funds all the time, or do you raise them for specific needs?
Yeah, well, we have an annual cycle. So we raise the bulk of our funds each year from September through December. And then the capital gets pooled and invested the next calendar year. But we also keep the fund open. So if someone wants to join late, that we can often squeeze them in. But we aggregate the capital, pool it, put it in the bank, and then invest it during the course of the calendar year.
Okay. Hey, let's open up the microphones and let people ask. I'm sure that there are a lot of questions out there. Ashish, you've been very quiet. That's uncharacteristic for you. So let's open up the microphones and see what people say.
Eric, I've actually been manning the chat and trying to give people their answers based on my experience as an investor with OVF. But one of the questions we got was, what are the minimums to invest?
Yeah, it's 50,000 per year is the minimum, $50,000 per year. And about half of our investors invest at the 50,000 level, and about half invest more per year. And then each year we invest in 6 to 10 companies. So it's a way to get a diversified portfolio of startups pretty quickly. And we encourage folks to invest for 4 to 5 years to get the full diversification benefit.
There's a question about tax gains and what sort of, curious about what the tax profile looks like, and is how tax advantaged are the investments? And do you need to be accredited also?
Yeah, the answer is yes. All our investors need to be accredited, and it's self-certifying that you meet the accreditation standard. No one's going to double check. And on the tax side, we're shooting for long-term capital gains. And that said, we work really closely with our attorneys and accountants so that most of our investments are eligible for qualified small business stock exemption, which means that if certain conditions are met with an individual investment, the gains pass through tax-free at the federal level, and in states like Oregon and others, depending on the state, also at the state and local level. So more than half of our proceeds that we distribute are actually tax-free. And that's because we're working with the company to make sure they're eligible for a qualified small business stock. Now, when a company doesn't work out and we have a realized loss, that passes through as well, and the losses can offset gains. And as I said, about half of our investments over time end up as a realized loss, and the other half as gains. If without the qualified small business stock, the gains would be subject almost always to long-term capital gains tax. Yeah.
Okay. I am not seeing any other questions here at the moment. Do we have more people that want to take themselves off mute?
I can take myself off mute. So my question is, I heard the minimum, and this is because I'm going to ask a question that is probably going to be generic, but if you don't have like 50,000 lying around, right? Like, what are some ways that, again, I'm very new to all this, is how do people get this sort of money? Is it you just have to borrow and then invest, or like how do people typically come up with some of this money that requires for like minimum investment?
Yeah, I would not encourage borrowing to invest, and I would not encourage investing more than 20% of one's investments in venture capital in general, just because it's risky. It's high risk and high reward. So, it should be a small percent of one's investment portfolio. That's my personal point of view. And unfortunately, that means that it's not accessible for a lot of people. If you don't have 50K available to invest, it's hard. And one of the things that we've worked really hard is to try to make it more accessible than the typical fund. Most venture funds have a $500K or even $1 million minimum investment, which means it's really only available for the uber wealthy. And that bothers us. We want to democratize venture capital and make it more accessible. And doing it at 50K, barely, it kind of works for us economically. The cost of administering hundreds of investors at 50K, it kind of works. If we did it for less, the overhead would outweigh the fees that we could charge, and it wouldn't be economically sustainable for us. So 50K is pretty accessible in the venture world, but I also realize that it's still high for some individuals.
Do you allow investment through trusts or self-directed IRAs, self-directed 401ks, or other vehicles?
Yes, we do. All of those. Yeah, and we can help. So if someone does have an IRA, with capital in it that we can help you with the self-directed IRA. And Ashish can too. I know you're expert at that, Ashish.
Karthik is asking. One quick follow-up. Somebody's asking, can a group of friends create their own LLC and meet the minimums that way?
No, because the SEC also has rules about the number of individuals that can be in a fund. So it's really based on the individuals involved or married couples. And we can only have so many individuals and married couples. So if someone was in an LLC with 4 other people, the minimum would be 4 times 50K or 200K.
I'm curious, how many people are allowed into the funds?
Because we have several funds and working in parallel, we can have up to 250 investors in a single fund. Our venture partners are exempt from that count because they're active in the work of the fund. So there's an exemption for them, but we can have up to 250 passive investors in each fund. And so we try to make sure that we're managing that closely.
Hey, Eric, I heard you say there was a involvement by some of the investors in the decision making or in the vetting and the due diligence. Can you double click on that just one level?
Yeah, great question, Rich. We have a subset of investors we call venture partners, and this is a carefully curated group of active investors in our fund who are often leaders in their field. They just bring some kind of superpower to the fund, and they serve in all different capacities. We have some of them are ambassadors, and they represent us at local universities, regional universities, and incubators, and they help scout deals. And so over half of our deal flow comes from our venture partners who are out in the community representing us. And then when we screen and diligence companies, we involve investors who have expertise in that startup's market or in that area of innovation to help us with our diligence. And then when we make an investment in a company, we have one of our or 2 of our venture partners serving on the board of that company, and it makes our model more scalable. And so that they help us scout, research, select, and support companies. And we love to collaborate with them. And it's kind of our secret sauce, and founders love it because there's usually someone in our fund who knows something about their market that allows us to be helpful.
Yes. Okay. So not the investors in your fund, those are your venture partners that are helping them.
Yeah. And the venture partners are investors also, but
yes,
it's a subgroup. Yeah.
Okay. Gotcha.
Question.
Great. Thank you.
Yeah.
So let's say you invest in a fund ABC and that invests in company XYZ. And if that company XYZ goes south, so how is that handled?
How is it handled?
Mm-hmm.
Yeah, well, we thank the entrepreneur for the good effort. It's no hard feelings. We know everyone's doing their best and failure is going to happen. Hopefully we all learn from it. And we do a debrief. I didn't mention this, but we try to debrief, when a company succeeds and when a company fails, so we can learn from that. And then the losses pass through. So our investors receive a K1 form that shows gains and losses for the prior year. And if there's a loss, it flows through and it can offset other gains.
We've got 3 minutes left. I want to make sure that everybody has your contact information.
Yeah.
And then Shash has a good question here. It says, how is investor money allocated? Is it allocated to all the investments in the portfolio or only in selected companies? How is the return calculated for investors who invested in a Series A? And do you have a fund NAV that the investor is invested in on a given date? What's the dynamics of allocating between investors and companies?
Yeah, so like we were talking about before, the dollars each year are aggregated and pooled, and then that pool invests in a mini portfolio each year. So this year we have roughly $20 million that has been aggregated, And that 20 million will go into, I think it'll end up being 6 to 10, 8 to 10 of the top startups in our region. And so everyone in the 23 fund will have a share pro rata based on how much they invested in those 8 to 10 startups. And if they invest the next year, they'll have a pro rata share of those startups as well. And then when available, we'll offer the opportunity to double down on individual companies. It's not always available, but when we can, we try to make that available. So sometimes individuals can invest in their own name alongside the fund. And the other parts of that question, Daniel, were
they were, do you have a NAV?
A NAV, like a net asset value? Yeah, if I understand the question right, we track our investments based on book value, which is the most recent financing value. So if we invested at $1 per share and the next financing's at $2 a share, then we will mark up our investment to reflect the most recent value that someone paid to purchase stock. If a company doesn't raise any more money, then we won't mark it up. And if a company fails, we write it off. We try to keep that really simple. And that it's a little conservative. And so that's how we calculate. It's the most recent financing value or the exit value of the company.
All right, Eric, thank you so much for coming in and speaking to the Alternative Investing Club. Could everybody take themselves off mute and thank Eric for coming in?
Thank you, Eric.
Great.
Thank you.
Thank you, Eric.
Thank you,
Thank
Eric.
Thank you. Yeah. Thank you all. It's great questions and happy to follow up with anyone. I'll share my slides with Daniel and Ashish, and they, please feel free to circulate. Happy to answer other questions and eager to hear other thoughts. But thank you for having me. This was a real pleasure.
Thank you. The pleasure was ours. That was a great presentation, and thank you so much for sharing with us. We'll be back next week, and make sure that you sign up with the link that I dropped into the top of the chat for continuing to get our calendar events. And we'll be back next week with a topic on self-directed IRAs.
Great.
Thank you, Eric.
Great. Thanks, everyone. Be well. Take care.
And thanks, Daniel.
Thank you.
Thank you. Have a great weekend.